Before we dig any further into the fundamentals of investing, let's pause for a lesson on the economy and how it can affect your investments. Economic growth is measured by real gross domestic product, or real GDP, which we'll get into a little bit later. In addition to the forces of supply and demand, central banks and the government can also take action to stimulate the economy when appropriate. Central banks manage interest rates through the change of the supply of money, and this is referred to as monetary policy. The government, on the other hand, manages taxes and spending, and this is referred to as fiscal policy. Let's talk about monetary policy. The central bank in Canada is the Bank of Canada. If the Bank of Canada increases money supply, it'll cause interest rates to fall. This means it costs less to borrow money, which encourages consumer spending and investments. On the flip side, when interest rates are higher, spending and investments are reduced. Consumers are more driven to save their money. Under fiscal policy, when the government increases spending and lowers taxes, jobs are created, putting more money into our pockets, and consumer spending increases. This stimulates growth and strengthens the economy. When the government decreases spending and raises taxes, the opposite is true. There is less job opportunity and less spending. What indicates growth or decline in the economy? If we take a micro or narrow view, we can look at things like the individual markets of goods and services. Are things getting cheaper or more expensive? Are companies hiring more staff, or are you seeing stores close and people losing jobs? Are you earning or spending more or less nowadays? If we broaden this view to assess the economy on a macro level, we can consider a few things. Where are interest rates sitting? What are the levels of prices of goods and services? How are employment rates and inflation? Factors that signal the health of the economy can be a number of things: stock market performance, retail sales figures, consumer sentiments, number of build permits, housing stats, company earnings, unemployment rates, GDP, and inflation. Inflation is the increase in the cost of living over time, and this is something that both the Government of Canada and the Bank of Canada closely monitor. This is because rising prices affect our cost of living. For example, if the items you typically purchase at the grocery store rise in price, but your salary and spending budget remain the same, you might find it challenging to afford what you're used to purchasing. And if, for example, you keep your savings in a checking account for a long period of time, but that checking account isn't paying any interest, then the purchasing power of your savings will slowly erode away. Your money will not grow in value. The value of your savings remains stagnant while inflation is driving costs up. As a new investor, this is a very important factor to keep in mind when you're setting financial goals with long time horizons. By adjusting interest rates accordingly, the Bank of Canada uses monetary policy to keep inflation low, stable, and predictable. Inflation typically sits between 1% and 3%. Gross domestic product indicates how a country's economy is performing. It measures the total value of all goods and services that a country produces in a given year. If an economy is healthy and growing, then the GDP will rise. But if the GDP shrinks for 2 consecutive quarters, then this means that the country is in recession and the economy needs a correction. Now that you know the different ways that we can measure the health of the economy, what does this all mean in relation to your investments? As we learned, higher rates of economic growth can pave the way for more business opportunities, job opportunities, and salary increases. But if interest rates rise, then it becomes more expensive to borrow money, such as on credit cards, loans, mortgages, and lines of credit. So how might this affect an investment portfolio? Low interest rates may encourage investors to invest in company stocks, for example, whereas rising rates may discourage them from this type of investment. Instead, they may feel more encouraged to put their money towards interest-bearing investments or fixed income products. One example of this type of investment is bonds. Bonds are a fixed income product that pay out higher interest rates compared to savings and near cash investments. Ultimately, a growing, thriving economy doesn't automatically mean that your investments will perform well. It's important that you do your due diligence and research your investments. Ensure they are the right fit for you, your risk tolerance, and your time horizon. Understanding changes in the economy may allow you to make the appropriate adjustments to your investment strategy over time. It's not necessary to track every minute change in the economy, but it is important that you understand the bigger picture so you can have a sense of how changes may affect your finances.